Hello viewers, welcome to our channel. Today we are going to kickstart our new course, and this is going to be DCF Valuation Modeling. It's a DCF Valuation Modeling course that we are going to kickstart today. So what we want to look at for now is for us to learn more about the DCF modeling, and we can be able to see what we can have. So without wasting more time, let's dive in and look at the course overview. In other words, we are going to look at the summary of the course, all the things that we may look at. In other words, we are going to pick out those key things that make up the DCF modeling. Our DCF modeling, the DCF, actually the D stands for discounted, the D stands for discounted, then the C stands for cash flows. So it is discounted cash flow valuation modeling. It's the course that we are going to look at. So DCF valuation is one of the most common valuation techniques used in modern finance today. This technique is flexible in that it can be used for very early stage growth companies as well as established companies operating in a more mature industries. Although the DCF valuation is one of the soundest valuation techniques, errors in DCF models are actually quite common. Finance professionals often make mistakes related to the calculation and pairing of the company's cash flows and its discount rate. Finally, many financial professionals struggle with the right level of details for income tax calculations, and so they fail to correctly break out the current and the deferred taxes in both levered and unlevered income tax schedules. So this DCF, as you are seeing, is something that we probably want to look at. This DCF valuation modeling is something that we basically look at in terms of looking at the discount rate and at the same time looking at the cash flows. So the cash flow profiles and the discount rates, they always give challenges to financial professionals. And when those errors or challenges happen, it makes these things to be a little bit tricky. So you find it is problematic for financial professionals to actually get the right cash flows and the discount rates. And at the same time, you find some of them, they struggle in terms of the detailed calculations for income taxes for both the levered and unlevered income tax schedules, as we shall look at. So there is one key concept that we need to focus as far as discounted cash flow valuation modeling is concerned, and that's what we call the time value of money. The time value of money is something that we always use as far as DCF is concerned. But in our course, we prefer to call it, instead of calling it time value of money, we prefer to call it time quantity of money. So we prefer to call it time quantity of money. And we shall look at the reason as why we prefer to have that in that scenario. So we shall look at these things when we reach there, but we prefer to actually call them time, to look at it in terms of time quantity of money. Because what you have to understand from this perspective is that the movement of cash flows, the movement either backward or forward movement, is usually referred to as the time value of money. The movement of those cash flows, we always look at them as the time value of money, those movements. But now, as we've said, we prefer to call it time quantity of money because it's the quantity that is going to be changing. So we are not going to basically have anything or the value that is going to be changing, the value of the money. But we are only looking at it in terms of the quantity, because we believe it is only the quantity that is going to be changing. For example, for the backward movement, as we shall look at these computations in details, but you will be seeing something called discounting and compounding of different cash flows. But since we are looking at the discounted cash flow techniques, it means we are discounting these cash flows back from the time period to a given time period. And we are using the discounting rate to actually have that in place. So the things that we need to look at here is that we need to understand the objectives of someone going through the whole course of DCF valuation course. The DCF valuation modeling course will allow you to get exposed to the following things as long as you complete it with all the tutorials that we are submitting. So upon completing this course, you will be able to understand. Let's maybe look at some of the objectives. So the objectives, they're actually very many, as summarized in that sheet that we've displayed there. But what you have to understand from this point is that upon completion of this course, if you be with us until we actually finalize all the things that we are supposed to talk about, you'll understand how DCF valuation compares to comparable trading analysis and precedent transaction analysis. And then you will also be able to have the knowledge of knowing the pros and cons of each of the valuation techniques, because the DCF valuation technique and these other two, the comparable trading analysis and the precedent transaction analysis, those are the things that we use when we are actually trying to do the business valuation. So when you complete the DCF valuation course, you'll be able to compare the DCF valuation techniques with other valuation techniques, and you'll be able to see the advantages and the disadvantages of using any of those two valuation techniques against the DCF valuation. Because remember, we said this is one of the most commonly used valuation techniques of recent. The other item is you'll be able to review the importance of upfront model design and the best layout for DCF models. So you will be able to understand the importance of having an upfront model design and the layout of the DCF model, because we shall see this when we have optimized this model for presentation or for printing. Still, you will be able to discuss the common errors made with income taxes and the need for both a levered and unlevered income tax schedule in the model. We need to have an understanding of the income taxes, because we need to understand the current and the deferred taxes and their implication towards our model building. So you'll find you'll be able to understand the common errors that are done when computing the income tax values, especially the current and the deferred tax, and how we'll be able to treat those in our financial models. The fourth objective is that you'll be able to understand the importance of pairing the right cash flows with the correct discount rate. The right cash flows, of course, those are the cash flows that we shall see as we move ahead. Even the discount rate or the work, we shall be able to have an understanding of pairing the right, supposed to be the actual word there is the right values to use, because there is when you use the wrong cash flows and you pair them with a wrong discount rate, and you'll also be able to see the implication for that. And at the same time, we'll be able to review the steps for calculating each of those values in details, calculating the right cash flows and also calculating the right discount rates to use. The other objective is we shall be able to build separate schedules for both perpetuity methods and the multiple methods for calculating the terminal value, and discuss the common errors related to timing. Remember, for those who may be having some theoretical bit of financial management, you will also understand that it is actually very important for you to know when you're supposed to receive the cash flows, leave alone knowing the right cash flows. But at the same time, you need also to be knowing the right timing, or the timing of those cash flows. Are they coming at the beginning of the period? Are they coming at the end of the period? Or they are coming in between the period? A period can be a year, can be a month, it can be a quarter, whichever it is, as long as the cash flows are coming in that specified period of time. So you'll be able to understand even the timing is also very important. Lastly, we shall be able to understand design, and we shall be able to understand, after completing this course, we shall be able to understand how to design and build a dashboard for stakeholders using data tables. Remember, everything is going to be done in Excel. We will be able to use data tables. So for those who actually don't understand how to use them, it's be the right time for you to actually get to this point. So it's better you make sure that you follow through until we finalize these values, because it is very important. These data tables, the data tables are actually very important. So that's basically what we can talk about as far as looking at the overview of this DCF valuation modeling course. Remember, this DCF valuation modeling course is one of the courses that actually form the financial modeling, that's FMVA, because it is very key for the FMVA course to actually include in the discounted cash flow techniques, because the DCF valuation modeling course, it is one of the core courses that are supposed to be attempted if you are to actually become very good at financial modeling and then valuation. So that's what we are going to look at. So without wasting more time, let's go to the next video and try to look at we start off the course. We look at the outlines, the things that we are going to talk about, and we shall start from there. Thank you for watching. Let's meet in the next video.